Assalamualaikum and hi, my name is Christina. Today I'm going to present about question 1, which is the ratio for Seri Meru Cinderella head. First one, liquidity ratio. The ratio measures the amount of liquidity for covering the firm debt and provide a broad overview of company financial health. The higher the ratio, the easier the ability to clear the debts and avoid defaulting on payments. Let's see the current ratio. Seri Meru had high liquidity 3.81 times compared to the average industry, which is 2.5 times. It means Seri Meru has more current asset than current liabilities. Seri Meru also has more flexibility to weather unexpected expenses and invest in growth opportunity. Next, we go to asset management ratio. Asset management ratio are essential for determining how efficiently the firm manages its asset to generate sale. They indicate how quickly a company is able to convert its asset into cash. Let's see the inventory turnover ratio. Seri Meru had a lower inventory turnover 2.66 times compared to the average industry 4.5 times. Seri Meru might be holding onto too much inventory, maybe due to inaccurate forecasting or slow sale. A reason for the weakness is maybe because of poor inventory management policy and procedures. Inventory management teams without automated system may struggle to improve efficiency and reduce their order cycle time, making it almost impossible to increase inventory turnover. And for recommendation, Seri Meru can improve forecasting accuracy by utilizing data analytics and forecasting tools to predict demand more accurately and avoid overstocking. Average collection period. Seri Meru had a higher average collection period, which is 101 days, compared to the industry average 80 days. It means the firm is not very efficient in collecting its debt. A high collection period could mean customers are taking their time to pay their bills. Reason for the weakness may be because of loose credit approval processes, low payment terms, or ineffective collection practices that can contribute to delayed payment. Longer collection times tie up valuable resources in outstanding receivable and hindering the firm's ability to access cash for day-to-day operation. And for recommendation, Seri Meru can tighten their credit and collection policy by implementing strict credit worthiness checks and shortening payment terms and establishing clear collection procedures. Non-current asset turnover. Seri Meru had a higher non-current asset turnover, which is 5.36 times compared to the industry average 4.1 times. It means Seri Meru is effectively generating sales from its fixed asset like machinery. This could be achieved through high capacity utilization and effective maintenance. Total asset turnover. Seri Meru had a lower total asset turnover 1.34 times compared to the industry average 1.5 times. It indicates that Seri Meru is likely not effective in generating sales from its asset. The higher the asset ratio, the more efficient the use of the company's asset. A reason for the weakness may be because of lower asset utilization can lead to the lower revenue and profit. This can negatively impact shareholder value and investor confidence, and it might have limited resources to invest in future growth opportunity. And for recommendation, Seri Meru can focus on strategy to drive sales like expanding into new markets, upselling or cross-selling existing product, and improving pricing strategies. And the third one is leverage ratio. Leverage ratio measures the overall debt level of a business, as well as business ability to repay new and existing loans. In other words, leverage financial ratio are used to evaluate the company debt level. Let's see the debt ratio. Seri Meru had a higher debt ratio, which is 29.09%, compared to industry ratio 22%. It means how much debt is used by Seri Meru compared to the total asset. And reason for the weakness may be because of undertaken aggressive expansion strategy that requires substantial funding. And for recommendation, Seri Meru can increase sales revenue and hopefully for the profit. This can be achieved by raising prices, increasing sales, or reducing costs. The extra cash generated can then be used to pay off existing debt. Time interest earned. Seri Meru had a higher time interest earned, which is 14 times compared to the industry ratio 9.6 times. It indicates a positive situation for the firm because it shows Seri Meru has the ability to pay interest expenses in business. Profitability ratio. Profitability ratio measures a company's ability to generate income relative to revenue, balance sheet asset, operating costs, and equity. Profitability ratio are used to evaluate how much money your business is making or losing. Let's see the net profit margin. Seri Meru has a lower net profit margin, which is 9.43% compared to the industry average 10%. It indicates that the firm is less efficient at generating net profit from sale than its competitor. A reason for the weakness may be due to many overhead costs. Overhead costs are all the expenses associated with the running business. Too much overhead costs can consume the profit and make it difficult to compete against other businesses in your industry. And for recommendation, Seri Meru can reduce its overhead costs. For example, try to negotiate for better terms with the vendor and implement cost-cutting measures to eliminate inefficiency in operation, which can lead to the cost saving.
Hi, my name is Intan. So for return on asset, we can see that Sri Meru had a lower return on asset, which is 12.6 compared to industry average, which is 15%. It means that the firm has a lower ability to generate net profit from sales. So the reason for weakness is poor management, which leads to wasteful spending, mismanagement of resources, and other problems. One of the primary reasons businesses have low profitability is that they are not tracking their cash flow. So the recommendation for Sri Meru Berhad is they must manage the cash flow of the company. For example, Sri Meru can set a budget and review the business spending regularly. For return of equity, we can see that Sri Meru Berhad also had a lower return on equity, which is 17.78 compared to the industry average, which is 19.23%. It shows that it generates less profit from common equity. The firm could be experiencing higher expenses and inefficient asset utilization. So the reason for weakness is because of investment decisions or project with low returns. It can also be the level of competition in the industry, and companies that can maintain a significant market share can generate a higher return on equity. So the recommendation for Sri Meru Berhad is to evaluate the company's capital allocation strategy. For example, they can prioritize projects with higher returns and ensure the capital expenditures align with the overall business strategy. Next, we'll be moving on to question number 2. So for question number 2, we pick Petron Malaysia, refining and marketing for this question, where we have to find out about their net income, revenue and expenses for the year 2020, 2021 and also 2022. Firstly, we will talk about the net profit of Petron. So from the graph, we can see that the net profit is increasing year by year, and there are many factors contributing to the increasing of the net profit. If we look closely, the net profit of 2020 is lesser than 2021. This is because of the COVID-19 pandemic, where the demand for oil and gas has decreased because of the Movement Control Order, which is MCO. So during MCO, people have been asked to stay at home, and because of this, the usage of transportation has reduced. During 2021, the net profit of Petron increased drastically because of an increase in international oil price due to the recovery of demand of oil and gas. And because of this, Petron are able to generate higher revenue when selling the oil at an international price. Last but not least, the reason for the rise of net profit in 2022 is because of the recovering in domestic demand. The MCO ended by the end of 2021, and because of this, people are finally able to do travel activities during 2022. And this leads to an increase in domestic demand because of the usage of transportation has increased.
Hi and Assalamualaikum. My name is Danish Shafiq, and without further ado, let's start by analyzing the graph of Petron revenue for the last 3 years. The revenue is constantly increasing from 2020, 2021, and finally to 2022. There are some factors that I would like to share with you. The first one is MCO order from government. MCO, which is Movement Control Order or PKP, Perintah Kawalan Pergerakan, is a new norm that has been implemented in Malaysia to reduce the rate of virus COVID-19 spreadness. The order involved people to stay in their house. This led to the reducing the transportation usage and automatically reduced the petrol oil demands. Next, in 2021, Petron has a new financial goals, which is to recover their finance from past year due to the COVID-19 and MCO crisis. Thus, Petron established a new strategy which involving remeasure the cost rationalization, resulting Petron to have 6 million cost reduction during the quarter and managed to increase their revenue compared to last year. Finally, in 2022, Petron revenue drastically increased by a huge number. During 2022, the MCO order has ended and they are free to leave their house, which resulting in a total increase for the usage of transportation and oil to operate their vehicles, which obviously made the price of the oil increase because the oil now receive a high demand. And this situation is the reason why Petron had high revenue during 2022. Let's move on to the expenses now. The graph of Petron expenses have the same pattern with Petron revenue, which is consistently increasing from year to year. This is mainly because Petron will need to pay some expenses to increase their amount of product to increase their revenue. So let's jump to the factors. In 2020, because of the MCO order, Petron really didn't need to spend their money for operating their business because the consumer during that day has been restricted to leave their house. Because of that, some operating expenses such as labor, utility bill can be cut down. In 2021, the MCO order has been less restrictive. Certain locations can now be visited, and Petron slowly gaining some customer from this situation. To make sure they can serve consumer with the enough oil and gas, they need to increase their expenses to meet customer demands. And finally, in 2022, the expenses during the year has skyrocketed compared to the last year. The increase in revenue is mainly driven by the ending of MCO order, which is in December 2021, which increasing the total demand from consumer as well as the operating costs and other expenses like tax, which led to the increase in total revenue during the 2022.
Hi, I'm Daniel. So I will explain about the distinction between these two analyses, which is trend analysis and interfirm comparison. Okay, so we go for trend analysis. Point number 1, internal focus. As an internal analytical technique, trend analysis examines financial data for a corporation over time to find trends, changes, and trajectories in key performance indicators. Financial managers and other stakeholders can have a thorough insight into the internal dynamics and performance patterns of the organization with this strategy. Point number 2, time frame consideration. Financial manager and analysts can examine a company's past financial performance and identify significant patterns by taking time frame consideration into account while doing trend analysis. Through an extensive analysis, frequently spanning multiple years, this methodology facilitates the identification of enduring patterns and oscillation in crucial financial metrics. Decision support. Trend analysis offers a dynamic perspective on a company's financial performance across time, making it an essential tool for financial managers. Through a careful examination of critical financial metrics like earnings, costs, and profits over time, financial managers can learn a great deal about the direction and scope of organizational changes. They can recognize patterns and trends that may point to areas of strength or areas that require attention because of the historical background. Okay, now we go for the interfirm comparison. Point number 1, external benchmarking. External benchmarking is a strategic analytical procedure that compares a company's financial metrics to those of its industry peers to assess its performance compared to industry norms. This approach provides an important insight into a company's competitive position, indicating areas of strength and possible vulnerability. Competitive positioning. Financial managers assess a company's performance in comparison to its industry peers to identify competitive strengths and shortcomings. They obtain insight into the company's relative standing within the industrial landscape by analyzing various financial measures like profitability ratios, liquidity ratios, and efficiency ratios in comparison to those of similar organizations. Okay, so the last one, industry norms. Industry norms are important in ratio analysis because they provide a baseline for assessing a company's financial performance in the context of its specific business sector. Analysts can acquire useful insight into a company's relative standing and discover areas of strength or weakness by comparing its financial ratios to industry averages. The conclusion is trend analysis gives context for internal strategy by emphasizing performance trajectories, where interfirm comparison shows the company's performance to the larger industry environment. Next, I will explain some inherent problems and constraints of ratio analysis. So the problem that I will discover, number one, is varying accounting policies. The method of depreciation is an example of various accounting policies. For example, even if the economic performance is comparable, a company utilizing the straight line technique may report different asset valuation and profitability ratios than a company using the decreasing variance method. Window dressing. Window dressing is frequently used to manipulate the opinions of stakeholders, such as creditors, analysts, or investors, and it may be a sign of possible financial manipulation. Inflation impact. When the purchasing power of money declines over time because of inflation, the recorded historical cost of assets such as property, plant, and equipment may not accurately reflect their current market value. Take a manufacturing company that bought machinery 10 years ago. For instance, due to inflation, the previous cost of the machinery as shown in the financial records may be significantly less than what it will now cost to purchase comparable equipment. Size differences. The impact of size variation on financial ratios is an important factor to consider in ratio analysis. For example, compared to a larger company with higher revenues and expenses, the shift in profitability ratios may be greater if a small business experiences a modest gain in revenue or a slight decrease in expenses. Ignoring qualitative factors. For example, even though a business has excellent financial statistics showing profitability and liquidity, it may not be able to sustain itself over the long run if the management team lacks strategic vision or good leadership. The last one is limited historical perspective. Ratio analysis restricted historical perspective results from its reliance on previous financial data, which may not accurately reflect the dynamics of the market today or unexpected changes in the economy. For example, a ratio calculated with financial data from the previous year will not account for the impact of the current financial crisis, changes in customer behavior, or distractions to the industry. Thank you.